My name is Maurice Button. I'm the CEO of City and Financial Global, and it's my great pleasure to have with me today Charlie Lytle, who's Head of Corporate Broking and UK Equity Capital Markets at Goldman Sachs. Charlie, welcome.
Thanks, Maurice. Very nice to be on the line.
Let's go to the questions, Charlie. First of all, the UK has seen a 40% decline in listings since 2008. What factors do you think are at play here? And is the situation quite as bad as the media would lead us to believe?
Yeah, I'd start with one caveat to the headline, which is that, of course, if you take one point in time and fast forward to another point in time, you can see quite precipitous changes one way or another. If you go back, though, the pattern is pretty similar, which is between 2005 and 2008, there were about 44 IPOs a year. Between 2019 and 22, roughly 15 a year. So there's no doubt the trend is going in that direction. When you drill into it, you also see that back in the late noughties, there were more resources IPOs. And if you remember, of course, one of the factors that was very live in the UK capital markets at that stage was that London was a strong choice for both miners and E&P companies. And I think the numbers were bolstered somewhat by that trend of the moment. But again, I don't want to argue against the overall pattern, which is that we're seeing fewer IPOs here than we did over 10 years ago. So what's really going on behind it? I think there are three main factors I would look at. The first is, I think that PE has become a far bigger share of the asset management industry than it was 12, 13 years ago. And of course, they can step in as an intermediary for a lot of companies. And if you go back to the years 2005, 2006, 2007, a significant percentage of the IPOs, like more than 50% of the deals that were happening then, were companies raising between 100 and 250 million dollars. And of course, that's the sweet spot for a lot of private equity firms. They can step in and buy those companies that are growing to a certain point and absorb them in their portfolios. So that's definitely the first factor in all of this. I think the second is that back in that period of time, the UK had a particularly strong lure. I think after New York, it probably was the default choice for a lot of companies, and as I was saying, in resources was probably the top choice for businesses, and that was partly to do with the depth of the market, the index money that was tracking, and also slightly different governance responsibilities and environment than that we had back then, and that definitely was a live factor. And I think that the third trend would be that as we've moved through the last decade or so, of course, growth has been a big factor in companies coming to market, particularly in North America. And investors in the capital markets who've invested in growth have generally outperformed over that period of time. So the attraction of value investing has been sort of slightly less than it was, and that again I think has probably counted against London, given the bias of London towards that part of the investing strategy. And so I think those three factors coming on top of some slightly idiosyncratic ones are probably the key things I'd identify.
Very interesting. I mean, the point you raised about private equity, and I guess the broader debate about public versus private markets is quite key. And that didn't really stand out from the Chancellor's recent Mansion House reforms. I mean, he's clearly there are plans afoot to reform the prospectus regime. There's the investment research review. And this new intermittent trading venue sort of bring along companies. But do you think that those are really going to make a huge difference? Or do you think that there's a need for a broader assessment of public versus private markets? And in that regard, if that is a factor, what can be done about it?
I think that it's impossible for governments to dictate capital markets and where people will list, and that includes existing companies that will make choices around listing venue, as well as companies that are considering coming to market. To my mind, though, making the UK as attractive as it possibly can be is important, and I don't think we're going to reverse the shrinkage in UK-oriented money that we've seen over the last 20 plus years, because some of those reforms or some of those weightings date back to reforms made by Gordon Brown and other governments. But I think behind all of that, there is also now a less parochial investing landscape than there was, in that there was probably a time where many asset managers didn't really have to look beyond the UK. And I remember advising large companies that were in their minds comparing themselves to global players, and yet they found that some of the asset managers they were dealing with were still really comparing them to UK peers in the wider sense, in that they had slightly different business models, maybe geographic mix of business, but nonetheless they were being compared because they were a UK telecoms company or a UK bank or whatever. And so I think it is probably sensible for investors to be thinking globally, and that's of course where asset allocation has trended over the last 20 years. But I think a number of the things that have been identified by initiatives around this, and there are obviously more committees on this than probably anyone can keep up with, but a lot of the coordination's been been done by LSIG, is to just make sure that we're not putting in place structures that are anti-competitive, and I would look at that through various different lenses. So firstly, is the governance structure and culture here attractive or unattractive for listed companies? Secondly, and connected to that, are the remuneration arrangements uncompetitive? Thirdly, what is the UK doing about pools of capital that could exist here? If you look at a thriving equity market like Australia, part of this is because they've compelled savings, and there's a weighting towards equities, which means there is significant equity investing within Australia. So I think that government working in tandem with investors can make quite a big difference, and of course part of that are the potential listing rule reforms that are coming through, and I see all of these things as incrementally helpful. Are they transformative? Probably not. But actually, we're playing in a global market, a bit like we're playing in a global market for talent, and that extends to all of us and our employees. There was a time probably where large UK banks, certainly when I started off, were recruiting predominantly from the UK and from a narrow demographic within the UK. That's changed, thankfully, in our working lives. And I see that as sort of reflected in also the way that the capital markets go at things. So, there was some interesting analysis put out by one of the committees a couple of weeks ago around the differences in recommendations that the likes of ISS and Glass Lewis apply to companies, whether they're listed here in the US or elsewhere, and the anomalies within that reflect a governance culture probably driven by a relatively small group of investors, and should they be dictating how the rest of the market operates at a time where probably there is more focus on governance than there's ever been. And I think it's therefore a helpful step for people to be gently challenging some of these things and just making sure that the majority are comfortable with them, rather than the minority being able to influence in a way that can then make the UK market a less attractive or alluring place to be listed.
Yeah, so it's really a sort of multiplicity of different factors, and you're saying you think that these reforms, the Mansion House reforms, are all helpful, but they're not a silver bullet by any stretch of the imagination, and times have moved on and have developed, and the dominance of US, UK listings perhaps has been challenged. Do you think that the movement to the centre of economic gravity towards the east will make this problem, exacerbate this problem further in future years, as Singapore and other thriving economies there develop their own equity capital markets. Do you think that more companies will be attracted in that direction as economic activity increases in that part of the world?
I think it's a very good question, and I think fundamentally yes. I don't know. Last time you were in Asia, I was there a month or two back. It's booming. Whatever the headlines around China and momentum, clearly just being on the ground, you can see the momentum in the ASEAN, Indian, and local economies. And I see no reason for that to change. The wealth will grow in the region, and of course that means there's more capital to deploy. The institutional and pension market is much less developed than it is in Europe and the US, and of course it requires a heft of investors to ensure that businesses will generate substantial value, because they need those investors to participate. But I see that trend towards global investing as something that is likely to continue. And why wouldn't those global investors be prepared to invest in the winners in the region? I see every reason to believe that will happen. And so, I think that is likely to be the trend we see. And you can see it in a micro level with companies where you compare maybe some of the local valuations to peers that are listed elsewhere, and you see often that they trade at significant premiums. So I'm sure that's going to happen. I think we're going to have more fractured capital markets in that regard. And I say that against a slightly ironic background, of course, where the US stock market is being driven at the moment by a very small number of companies that massively outperform.
Yes, that is quite a strange factor, isn't it? Well, I think, Johnny, sadly, we've run out of time. Thank you so much for sharing those very interesting thoughts with us. And of course, we'll be continuing these discussions at the Future UK Capital Markets Summit, which is being held on the 25th of September in London. I very much hope that our viewers will be able to join us at the summit in person. So thank you very much, Johnny. See you on the 25th.
Thanks, Maurice. Very good to speak to you. Thank you for the time.
Thank you.